Hello, everyone, and welcome to another episode of Market Update, featured by Rationale and Marketsall. Just a reminder, Rationale offers a newsletter like service delivering trade ideas and insightful market analysis across various financial markets, including global equities, forex, crypto, futures, and ETFs. And Marketsall is a multi-asset trading platform that provides access to currency pairs, including major, minor, exotic currencies, as well as other financial instruments such as stocks, commodities, and indices. And I'm Roy, the founder of Rationale, and I'm excited to bring you the latest updates from the financial markets. Um, Today, I would like to start by examining the latest developments in the Chinese economy. I'll then move on to provide like quick overview about the most recent ISM numbers that we received from everywhere. Following that, we'll take the deep dive into the factors behind the strong performance in the equity markets. What factors are behind this like strong performance? And finally, I'll try to discuss the important messages that we received from Fed members last week. It was really like a busy week. That's why it was also really important. Yeah, let's get started. And yeah, here first of all, is China coming back? That's the question. As you might follow that, the China has struggled a lot, especially due to domestic challenges like the real estate crisis, household consumption, the deflationary pressure. China struggled a lot during 2023. Also, they keep struggling now. Accordingly, like the expectation of policy support from the government, from the NPC, the National People's Congress, has been the main topic in recent times in China. In terms of like if they're going to support the market with policy support or not. And at the beginning of last week, we received PMI numbers from China, and the March manufacturing PMI data came 51.1, which was parallel to the survey, and it was slightly higher than the previous print. As you know, like if the PMI number comes above 50, it is considered as the economy is in expansionary territory. In that terms, this was a positive scenario, positive fact for the Chinese economy. More importantly, in March 2024, new orders in China saw a rise to like a 53 points, as you can see here in this chart. Here you can see, and it is up from 49 points recorded in February of the same year. Like over the period of 2005 till 2024, the average new orders in China stood around like a 52.6, like around that number. As we see better PMI numbers coming from like other countries, we will be better convinced that the improving export numbers of China would be sustainable, since like they are the buyers, right? So better than expected economic numbers actually pushed CSI 300 index higher, like the main benchmark for the mainland quoted stocks. They rose around 1.65% on last Monday after data. It was the best day over a month, as far as I remember. Like even though like the NPC side, the National People's Congress, might not have like a fully implemented change to boost productivity, get the economy growing again through more spending at home. Like there are plenty of plans in the works, and President Xi can now use a recent PMI survey as a proof that China economy is at least like getting back on track after the tough times, and hoping to attract foreign investors after foreign investment hit 30-year low in 2023. So China's basically saying it's still open for business, and there's still money to be made in China, and they've already made some moves like to make things easier, like loosening rules to relax restrictions on foreign investment in certain areas. And like despite the tough times, Chinese stocks are really a bargain, like to compare to US ones. That might also be attractive like um, for some Western investors to buy MSCI's, like to buy in. Like, and MSCI is like China index. If you compare it with the US counterpart, you would see that you will see that like MSCI China index trades at a forward earnings multiple of less than 10, and US counterpart is 22. So like there is a like huge difference, and like relatively there's a cheap market. Also, like when I generally like I check China, I also like to show you the Hang Seng index situation technically here. This is a daily chart. As you can see, after like let's say a downtrend coming from the beginning of 2003, there is a head and shoulder bottom chart formation after a downward after the downtrend, and a potential breakout of this would be also in line with the China, like the idea of Chinese economy getting back on track. So yeah. And the other topic is, what do ISM numbers tell us? The ISM, like with the ISM manufacturing PMI number coming 50.3 last week, the US industry returned to territory, like positive territory for the first time in the last 16 months, which is like a positive thing for the economy. And it implies actually, I mean, while it's a good sign for the economy, it implies a fewer rate cuts. And the increasing ISM prices, on the other hand, shown in this chart, you can see here, just here, as you can see, the ISM manufacturing is the blue line, and the white white line is the ISM manufacturing prices paid. As you can see, there's an increase there. Like, it's a bit concerning. In what sense? The Fed has made progress on good inflation, right? Compared to service inflation. Now, I mean, when you evaluate the inflation, service inflation is the problematic part compared to the good inflation part. Therefore, if we see a potential price increase warning on input prices like this, like ISM manufacturing prices, might push Fed to be more hawkish than expected. In that terms, it's a bit concerning uh, for the market, but for sure, like with just one data, we're not coming to like an idea that the general picture is changed. But yeah, just to keep in mind. And the purchasing manager index, this is also like compiled by S&P Global. According to this chart, the global economy has surged beyond the critical 50 mark. As I mentioned before, like if the PMI numbers like come above 50, that means economies are doing good, like it's in expansionary territory. But as you can see here, um, both the US and Chinese manufacturing sectors are contributing to this upswing, although Europe still lags. Also, this week there's going to be ECB. Like, just a quick reminder. So this having like above 50 numbers is a great news for the economy, people who work in it, and the economy is trying to sell stuff. But for investors, it could mean disappointment, because interest rates might have to stay higher than they were hoping. And also, like the charts that you see right now, yeah, illustrates the overnight index swaps market's expectation expectation regarding the number of rate cuts by the Fed and ECB. It's like it's comparing it. So the expectation regarding the rate cuts have been significantly reduced since the start of the year. Like, sorry, yeah, here you can see it's the January chart. Um, Here the expectation was around like a 6 to 8 range, the rate cut numbers, and now it's we see an upward shift. As you can see, um, since the U.S. economy is doing better than Europe's, as I mentioned in the like previous slides, according to PMI, you can also see that expectation for U.S. rate cuts have changed even more. As you can see, the white line compared to January 2nd, April 2nd, it went up much more. Yeah. And yeah, the other topic that I would like to talk about is like why do stocks, equities hold well like in such high rate environments? That's the question I have received like a couple of times. I mean, they're saying like we're waiting for the rates to come down to see much more appreciation in prices and stuff, but rates are already like high. Why? I mean, how can the stocks can hold those levels that like that strong, you know? So the chart that you see is this S&P 500 index and US 10-year yield chart. It shows the recent positive relationship between rates and equities. So the phenomenon of and high rates would lead to low equity pricing is mainly a valuation team concept. This means that like the phenomenon of high rates leading to low equity is largely based on how assets, like particularly equities, are valued in the financial markets. Like when interest rates increase, the discount rates are used to value future cash flow, like from equities also increases. Like the valuation is made through, let's say, DCF model with discounted cash flow model. They're using a discount rate and they're getting a benchmark rate, and so that benchmark rate is derived through interest rates, right? So this higher discount rate, as the rates are high, this higher discount rate lowers the present value of those cash flows, leading to lower stock valuations. So this is the main logic behind this phenomenon. Actually, if we see like if the rates are going high, that means valuations will be like the cash flow discounting today like to the present value would come like a lower. That's why they will like the valuation on those equity prices will be low. That's the main logic behind this. So the question here is like basically to get out of stock market just because the Fed fund rate is high is questionable in that sense. Like for sure, high rates can make it tougher for companies to grow and can put pressure on stock valuations. But usually rates are high because the economy is doing well actually. um, as long as but the like the here is like the important nuance is like as long as the high yields are accompanied by like strong economy, the stock market performs well. That's why we need to follow carefully like signals coming from the real economy related data, such as like a non-farm data, as we received like last week, which was like the headline number was really high, but stock market did well. I think like the main driver behind it was the average hourly earnings, were like the wage-based inflation threat was coming down. That was a signal that was derived from there, and that was a like a positive part. Yeah, and as I mentioned in the previous video, like if you had watched the if you watched the like first video, uh, we I mean I had like there were like a three different headline to follow like data, like first real economy related, inflation related, and events risk. So currently in the current conjuncture, I would say like I would follow like um, at least I will put a little bit more importance on the real economy related, because it's the main thing that holds the equity market well right now. And yeah, and like high long term rates, generally, like what's the behind of this mentality actually? Why like high long term, like high rates is meaning like economy is doing well? Like high long term rates imply expansion and economic growth. Like if the market believes that economy is doing well, it means there will be a demand, right? Like an inflation in the future. If we see like in the if we see like high inflation expectation, that means like the general perspective about market is good. Like with this mentality, the market players compensate, like to compensate their for the potential higher long-term rates. If they expect better economy, they expect higher long-term rates. In order to compensate that potential higher long-term rates, they seek for higher long-term yield and sell the current treasuries as it's happening right now, with the expectation of buying a new one with higher yield. Thus, yields tend to increase. That's the main mentality actually. When the economy does well, you believe that okay, this rate's gonna go up. Okay, if there's gonna be better like fixed income like instruments, why should I be okay with the current low yield one? So I'm selling it. Yields are increasing, and when when the room to go is like restricted after a point, they will be buying. And like yeah, there are like also there might be a lot of other like drivers. Yeah. And in this chart, as you can see in the below 5 year and 5 year forward inflation uh, expectation chart, it's called 5 year forward inflation expectation chart by San Luis Fed. You can see the inflation expectation for the future. I mean, this is one of the benchmark chart that Fed is using. That's why I wanted to show this, like to show that inflation expectation turned up. Like that's a good indicator. As you can see here, like there's a upward tail, and yeah, I think this chart like really like showing that inflation expectation for the future started to rise, especially after recent inflationary spikes that we received on January and February. Yeah, tomorrow, like sorry, I think yeah, Tuesday. Yeah, Tuesday also. There's gonna be new inflation data. Yeah, I think that by the way, like by looking this chart, I might say that like this might be the main driver behind the postponing, like market postponing the rate cuts, and Fed also. Yeah, and also while we're talking about equities, I would like to mention about some general concepts about like there are like some equity categories like that are mentioning a lot. So what are they? Like momentum stocks, growth stocks, and value stock. And I like, for example, in momentum stocks, this SMCI here, Carvana here, these like lately the while the stock market is booming lately, I mean they did really well. And growth stocks is generally like Uber, DraftKings, CrowdStrike. These are more I'll explain like briefly a little bit later. These are more like, as you might recall, after the COVID, like when there was a growth stock boom, Uber, CrowdStrike, DraftKings, they were doing like their performance were amazing. And value stock is more like well-established companies like Berkshire Hathaway, ExxonMobil, JP Morgan kind of stocks. So um, momentum stocks, actually, how to define it? Like those are stocks like buying the stocks with the strongest momentum and selling like shorting those with the weakest. It's kind of a buying high and sell higher mentality. That's how we describe the momentum stock actually. Conversely, like value stocks is more buying stocks that are cheap compared to fundamentals. Like you first check the intrinsic value by do valuation, and if you see that the stock price is cheaper compared to that valuation, it means that it's an opportunity. and that's more of a buy low and sell high mentality compared to if we like relative to momentum stock. And growth stock, it's much more similar to momentum stocks, and buying the stocks show the most consistent growth in earnings. So momentum and growth equities are not that different in general. But in an environment of a strong economy, momentum stocks, that's what happening right now actually, uh, surpass like growth stocks, as the offerings of growth stocks are no longer scarce, because when the economic cyclical like rebounds coming up, like finding a growth stock is kind of since you're looking for earning stuff, it's more like a picky version of it. But when there's a like general economy boom, momentum stocks generally outpace the growth stocks. That's what I'm trying to say. And also like a cyclical rebound, like that means like recovery in economic activity, um, like a typically following a downturn. After a downturn, if we see an economic recovery, we often see a boost in value investing as well. Like because as the economy improves, the undervalued stocks have the potential to increase in price and driving up their value. So yeah, lastly, I would like to like talk about Fed members. Like it has been a full week of Fed speakers. I will just like cover quickly what kind of messages we received from like just some of them, and what might be the potential implications. Just before just before like getting to the last week Fed speaker notes, the like a week before on Friday, on Good Friday, uh, Federal Reserve Chair Powell had a speech, and he emphasized that the robustness of economy suggested no immediate need for rate cuts again. So nothing new came from him just before these speeches, and he was like consistent with his actually cautionary view. So here, the table you see here, it's a table that I got it, as you can see here, Viraj Patel. You can search in X platform. The attached it shows the positioning of Fed members before this week of speeches. This week of before last week, their positioning. um, like following this kind of table, like maybe like also like the speech that we're going to receive afterwards, like keeping this table in mind would provide us to seek for potential transition of their thoughts. And in I mean with this way, like maybe we can get some hints about what what they're thinking, uh, what we don't get through the like meeting notes and stuff. That might be important in that terms. So he thinks that according to this table, as you might remember, there were like 10 in the like last projections. There were 10 members voting for 3 or more rate cuts in 2024. So we can say like this is dovish side of the Fed, let's say. And there were like 9 members voting for 2 or less cuts. And like Viraj Patel says that here, according to table, Waller might be the one switch to the, let's say, like a hawkish side, means that he joined to the team of 2 or less cuts. And when you follow his I mean his speech actually, sometimes like yeah, it supports this idea actually. And yeah, that's why like bear in mind about like this table, I think it's important. And yeah, what first of all, I'll start with Powell. He said like too soon to say. He said like too soon to say if recent price pickup more than a bump. Recent data have not materially changed the overall picture. That's a good sign. We have held our policy rate at its current level since last July. As shown in individual projections, the FOMC released 2 weeks ago, my colleagues and I continue to believe that the policy rate is likely at its peak for this tightening cycle. So, the important part here, this speech took place just after the ISM service data. And ISM service data is important in terms of it gives an indication on service sector, which, as you might recall, it's a problematic side of the inflation. So getting a lower than expected data from ISM service numbers, it also provided a dovish room for Powell for this speech. I mean, I'm not saying that he probably like changed his speech after he received the numbers, but the tone. I'm talking about the tone when they talk. Another member, Mester, she said that the Fed is getting close to confidence level for cuts, and she added that she doesn't think neutral rate will be as low as it was. Uh, so um, just remember, like neutral rate is the interest rate that would prevail when the economy is at full employment and it's like stable inflation. And yeah, it's expected that the new rates won't be as low as it before as low as it was before, like just after COVID environment and stuff, for sure. We'll see. Yeah. Fed Kashkari. He said Kashkari is he I think he had a vote right last year, but this year he's not voting. But yeah, listen, like he said, interest rate cuts may not be needed this year if progress on inflation stalls. That's like assertive, especially if the economy remains robust. I mean, as I said, he's not voting in 2024, but after his speech, there was a strong sell-off in S&P index. Another member, Dali, projection of 3 rate cuts is not a promise. We have to be ready for inflation is stickier than we project. We may want to cut less. If the labor market starts to falter or inflation comes down faster, we are in a position to cut rates more. We are ready. The policy rate is at a good level. Yeah, I mean, in general, I'm not going to read like all of them, but in general, the main message is what I get. Nothing is new, actually. They just want to show their like cautionary side, and yeah, like they're just like warning the market. Okay, if something happens, we'll be there, and we might do anything. Just be open for everything. They just want to provide room for themselves for any kind of action. But I think as long as like we, in general, the general picture, okay, we see some inflation spikes, but seeing like ISM service number coming down, average hourly earnings coming down, because those were the parts like wage inflation and service inflation. These are like these were the important part of the inflation, and coming like positive signs. I think the general picture hasn't changed yet, and that's why I'm following inflation part for sure. It's so important, but also like real economy related side. I will be really cautious on that side. And we received the non-farm data, and now we're going to receive inflation data. Super core inflation would be so important. If you go to the like previous video, we covered the like what's super core inflation and the details about that. And yeah, that concludes today's market update, actually. And thanks for your time from now. Like, please don't forget to subscribe to Marketsall and Rationale for further insights and analysis. And yeah, until next time, happy investing, and thank you for joining us. Have a good one.